Everyone thinks the next global financial crisis will look like the last one. A sudden crash, red charts, panic headlines. It won't. The next crisis won't explode overnight. It's being assembled quietly, piece by piece, while markets celebrate record highs. And the most dangerous part, all the warning signs are already flashing, but they don't look dramatic enough to scare anyone yet. Right now, the global economy feels strangely calm. Stock markets are strong. AI stocks are flying. Governments say inflation is under control. But under the surface, something is deeply wrong. Global debt has crossed $315 trillion, more than 3 times the entire world's GDP. That means the system doesn't just rely on growth anymore. It relies on nothing going wrong. And historically, that never ends well. When the next crisis hits, the official explanation will sound simple. They'll say it was inflation, or interest rates, or geopolitics, or an unexpected shock, a war, a cyber attack, or a market crash. But that's just the surface story, because real financial crises don't come from one mistake. They come from multiple fragile systems failing at the same time. And right now, nearly every major system is under stress. Because the real problem isn't what's breaking. It's what's already stretched to the limit. Let's start with debt. Governments are running massive deficits. Corporate debt in the U.S. alone has crossed $12 trillion. And globally, the derivatives market now exceeds $600 trillion. That's not money sitting in a vault. It's a web of promises, leverage, and contracts tying banks, funds, and countries together. This system only works when borrowing stays cheap. But interest rates are rising. And most of this debt was created assuming they never would. It's like building a skyscraper on floating ground, and then acting surprised when cracks appear. Now look at the warning indicators. The yield curve is inverted, one of the most reliable recession predictors in modern history. The SOM recession indicator has triggered. Leading economic indicators are falling. Unemployment is quietly rising. Corporate bankruptcies in the U.S. are at their highest level since the 2008 financial crisis. These are not random data points. They're the economy tapping the brakes, hard. Yet markets are acting like nothing is wrong. And this disconnect is where things get dangerous. Today's stock market is more concentrated than ever. The top 10 stocks now make up about 36% of the entire S&P 500. Most of them are tied to one narrative: AI. AI is real. It's powerful. But markets aren't pricing reality. They're pricing perfection. Companies with modest profits are trading at massive premiums based on future promises. Debt-financed AI investments are growing. Circular deals are becoming common. This looks uncomfortably similar to the dot-com era, when innovation was real, but valuations were fantasy. Markets aren't fragile because people are pessimistic. They're fragile because everyone believes the same story. Now comes the sector most people are ignoring: commercial real estate. Nearly $1 trillion in CRE loans mature in 2025 alone, almost triple the historical average. Most were issued when interest rates were low, and office buildings were full. Today, national office vacancy rates are near 20%. Property values are down. Refinancing often doesn't work anymore. CMBS delinquency rates have crossed 7%, far higher than traditional bank loans. Hundreds of banks are heavily exposed. Some have unrealized losses larger than their entire equity. This isn't a crash yet. It's pressure, quietly building. But this crisis doesn't stop with banks. Risk has moved into places people don't associate with danger. Buy now, pay later debt is exploding, now packaged and sold like mortgage securities. Households are more fragile, with less savings and higher reliance on short-term credit. Crypto markets remain built on what regulators call a liquidity illusion. In October 2025, crypto prices collapsed again. Liquidity vanished. Prices dropped over 30% in hours. DeFi systems simply shut down. No lender of last resort. No safety net. Add to this the rise of deep fakes, AI-driven trading, and cyber risks capable of triggering digital bank runs in minutes, not days. The system is faster, but far less stable. Here's what makes the next crisis different. Central banks have limited tools left. Debt levels are already extreme. Political gridlock delays response. And global trade is fragmented by geopolitics. In past crises, governments could stimulate aggressively. This time, they're already deep in the hole. When the shock comes, the margin for error is tiny. Here's the uncomfortable truth. Crises don't happen because people don't see them coming. They happen because everyone sees them and assumes someone else will fix them. Finance isn't numbers. It's human behavior amplified by leverage. And every crisis teaches the same lesson. Greed wins the short game and destroys the long one. And if you think this system is stressed now, wait until the trigger finally pulls the web apart.